each of these illustrations, so what you might notice is that they're all $25,000 as the initial premium. This is on a 25-year-old, and the initial face amounts will vary because we will design these slightly differently. So this is the optimized longest funding. This is the optimized shorter funding. Those match in the early face amount. But that's your insurance. That's the actual amount of insurance that you have in that first year. This is more than double the optimized policies. If you were going to do so personally, if you did have a death benefit need that you really wanted to fill, I would say get the optimized designs and then get a 30-year term or 20-year term or whatever amount of term that you think is necessary to have more death benefit early on. This video is part of a series. Check out the playlist here. Two of the most important things for a high cash value life insurance policy are the carrier itself and the policy design. In this video, we will demonstrate how you can have a terribly designed policy for cash value, even with a great carrier. In this case, it's Penn Mutual, but this applies to any carrier. If you're interested in working with us, check out the video description to book a meeting. But whatever the case, if your goal is cash value growth, then ensure that you're working with an agent that knows how to design a policy for that purpose. You can reference this video series to compare with illustrations that you might receive. You can see here this bad funding has a very large amount of initial death benefit. I wouldn't recommend this. That's not great, but again, all of the other values do match. And then what I would consider the worst funding, it doesn't have as high of a death benefit, but it does have same funding level, same age. So all of these for the same example scenario person. So just wanted to walk through that. Let's jump into this worst funding. I consider this the worst funding because in my mind, when I'm using this and when I think I want people to have cash value, so in my mind, I want cash value and access to my cash value as early as possible. And having early liquidity is important in my mind. It's a low chance that I'm going to die, and I have a couple of different policies and plenty of death benefit in total when I have the different policies that I have. Like I said, I have 3 policies in total, so I still keep a term. I have a long term that's super cheap insurance, but I also have an IUL and I have my whole life policy. So I have plenty of death benefit. That's why I want the liquidity though. So this has higher death benefit than is probably necessary inside of this policy. In the early, it's a 26-year-old has a very low chance of dying at this age, but it's about locking in that cheaper insurance and starting to fund and get cash in early. But we have no cash value for the first 2 years with this design because this is just a straight whole life policy. It's a $25,000 whole life policy. And this is the amount of death benefit that you get in a straight whole life policy. Commission on this one would probably be something like $25,000. My wife is the agent in our business, and that's the amount of commission. If she sold you this policy, she would have a $25,000 or so commission in that year one. That's a lot of money. And that's so when we compare this to the bad funding as an example, this will have a slightly lower commission. When we look at the okay funding, it's slightly lower commission as well, even more so. It's like half of the other ones. Now, and when we go to optimize, it's significantly less. When we are looking at designing for the client, we're minimizing that commission as much as possible in order to, and this is where policy design is absolutely important. So in order to get the cash value early on, we have to minimize that commission. That some of the costs that are in the early part of a policy are due to that commission. So the optimized max fund is the same. So looking here, we've got the same as the other optimized commission. So it's clear when you look at all these policies, the optimized ones give you that early cash value, and a large part of that is because the commission is significantly less. That's why when I first started looking at this concept, I thought, I was just going to work with somebody I knew to get one of these policies, saw what they had someone help them design, and it didn't look that great. And I eventually found somebody who I thought really was a great person to partner with, and he's the one who got us into this business, working with the right agent and somebody who knows what they're doing for this purpose. If you just want life insurance, I guess you can just work with whatever agent that's out there if that's your only purpose. But in my mind, life insurance that's dual purpose, turning it into an asset that is not, eventually it doesn't have to become a cost. That's another thing. None of these are showing this, but by virtue of funding at these higher levels, around by year 8, we could, in effect, do what's called a reduce paid up and stop funding, and we'll still have a decent amount of death benefit. So we would lock in a good amount of cash value and death benefit for the rest of our life, and we don't have to fund these anymore. And in effect, it becomes free insurance. So, this idea of buy term and invest the difference, that's automatically locking in your term insurance as a straight liability. It's not an asset. When you fund it a period of time, you'll have access to a lot of cash value, and you will then have a death benefit locked in for life. When I initially set out to do this, I had wanted to actually fund for a short period of time and do something like that. But once I discovered, this is really kind of great, I want to fund this as long as possible, with as much as possible. So that's why in this example, I went to show optimized funding for as long as possible. So with this worst policy, giant commission means that cash value suffers. So you can see here, this cash value is really weaker in the early years. So let's go ahead and spot check a time where you might be sort of getting settled in life at age 40. We have 442,000 in cash value, and what I did was I created these comparisons with the optimized designs, where this just runs through the math directly. So what we're looking at is this does still have a higher death benefit. So at age 40, we're still a higher death benefit in the worst funding level. We have a higher death benefit than the optimized designs, but our cash value is $82,000 less this design. Now, if we go down further, so where does this end up changing? At what point does this shift? So if we get to our retirement age as an example, so it's age 61. This is actually where the this funding level we cut off the optimized funding and sort of just switch to base, so that where you look at this age 61. So if we go to age 61 here, we can see that we go from funding at 25,000 per year to down to 4,000 per year. That's what's going on there. So if we go back over to this worst funding, you'll see that all of the funding levels are the same. So we funded these at age 61, all the same. Now this policy still is slightly ahead of both of the other policies in this age 61, but then it changes. So the death benefit at age 61, as we're sort of approaching the time when you might actually be nearing your life expectancy. I mean, in modern medicine, I don't think you're likely to die at age 61, but this is the time when death benefit overtakes it, especially in this optimized one. That's something to consider. So this is the difference, though, in cash value. That's where the drastic difference is. We're talking about hundreds of thousands of dollars in cash value difference by not having the optimized design. So that starts to pull apart. And so when we go down all the way to what is the later years, eventually the death benefit does overtake the optimized funding to age 61. But just keep in mind, what this has done is you've funded this at a significantly higher number. So this is funded with $567,000 more than the optimized funding to age 61. So that's a big funding difference. So what could you have done at this point when this overtakes it, and you're now having $637 of extra death benefit with this other policy? I mean, you could do a lot with $567,000 to make up that difference. So that's not a problem. But then also, if you just take the optimized funding, this is funded at still less than this policy that we're looking at, but it is more than the funding that sort of cuts off at age 61. So this one stays ahead the entire time. It's highest in cash value. So basically from age 61 on, this one has higher death benefit and higher cash value all the way through age 120. And so you'll see here, though, this is what's kind of funny. So when we get down to the bottom here, age 121, 96 years into this policy, you'll have funded at $819,000 more than the funding to age 61, but you'll only have $247,000 more in death benefit. So that's just something to keep in mind. And in this case, you'll have funded at $743,000 more than the max fund optimized policy, but you'll have less death benefit. So that's really just very clear. Wanted to walk through that and why this is a really clear comparison as to what you would want to do and how you might want to approach to having a policy designed optimized for your situation, because I probably wouldn't recommend this design for anybody. There's better designs if you wanted to fund with more money for a long period of time. And the okay funding, we'll get into that here in a moment. So let's take a look at the bad funding level, what I consider the bad funding level. It's just not really optimized, and you're paying for way too much death benefit early on, and that's going to cost you. But you do have some cash value in year one as a product of this. And your early liquidity is still slightly better than if we go over to the worst funding level. Your early liquidity is an improvement over this. You can see, there's some liquidity early on, but it's not my preference. If you compare this to the optimized policies and we scroll down here, similarly, it's age 62 where the other policies will pull ahead. The funding level starts to be a gap again as well, and you end up with, and I'll keep all of these on the screen so that we can see the total cash value and total death benefits. I'm just going to kind of scroll through it. I'm not going to talk too much through this because, again, I wouldn't recommend this for most people's scenarios. So it's not something that people should do for most scenarios. Now, it's not to say that nobody ever should, but it's just not where I would prefer. Yeah. So when looking at this age 62, that cutover happens, and we have less cash value and death benefit all the way through maturity. And so this goes out to age 121. It's a big difference. So significantly higher funding level than both of these and less death benefit for both of these.